Hey guys, you found it. Welcome to the Fearless Pursuit of Freedom podcast. I'm your host, Brandon Richards. I'm a real estate investor and avid entrepreneur based out of Flagstaff, Arizona. My company is OPF and we flip, wholesale, and buy businesses. Listen in as I interview the nation's leading entrepreneurs and discuss the monumental battles of business and life. Hey Clint, man, thanks for coming on the show. We'll just jump right into it. Tell us a little bit about yourself, and you gave me a backstory before show, but let us know how you got into it and where you are now. And kind of like, for me, in real estate, there's a lot of trial and error. You think you want to do one thing, and you're like, oh shit, that wasn't it. You go to the next thing, you're like, oh crap, well, that guy failed miserably at it, so maybe I shouldn't do that. So then you try something else, and then ultimately you end up in your niche. So yeah, I'd love to learn about your journey there.
You nailed it. Yeah, man. Happy to be here. Thanks for the invite. My name's Clint Harris. 41 years old, married. I got a 5-year-old and a soon-to-be 2-year-old, 2 little boys. We live at the beach in Wilmington, North Carolina. I had a single, first of all, totally agree with everything you just said about watching people fail. My mission for myself was to try to fail fast and fast forward the timeline of where I want to be, right?
Yeah.
So I had a 16-year career in medical sales. I came out of college and I spent 16 years in heart surgery, implanting pacemakers and defibrillators. So I was the rep for the company. Most of my friends are cardiologists, surgeons, electrophysiologists that I used to work with. So did that for 16 years. It's kind of a young man's game. You're on call nights, weekends, lots of local travel, but in the middle of the night and on the weekends. So I kind of always knew if I wanted to off ramp from that. I think the ability for our generation to save our way to retirement has largely been taken away. So I kind of always knew I needed to play offense, and I wanted to build an off ramp from that type of lifestyle. I loved it and I was good at it, but eventually if you don't want to do that, you got to have thought about that a long time ahead.
Right.
So I chose real estate as the vehicle by which we were going to do that. We bought a small portfolio of 9 single family homes when we were in Columbia, South Carolina. Very slow way to get ahead. A little bit of cash flow off each property, but not much. 1 or 2 headaches a year on each property. And then you multiply that by 9 and it just gets to the point that it's really not worth it. And you can start to do the math of what it's going to take you to scale to get to the 40, 50, 60 properties you think you need.
Yep.
And even though you do the math, like, oh, I'm going to buy this many every year. Well, the prices of those properties are going up, right? So it takes away your ability to get there. In 2017, took a promotion. My wife and I moved to Wilmington, North Carolina to take over the medical sales territory here. So Wilmington's a small beach town. There's 4 beaches in close proximity. We moved to a little island called Carolina Beach, which was kind of an up and coming fishing village type place. And that was the first time we've lived anywhere that had the opportunity to do short-term rentals or Airbnb. So in 2018, we bought a small duplex, 2 blocks off of the beach, 3-bed, 2-bath in each half. We did a renovation. We lived in one half. We started doing Airbnb with the other half. We did $57,000 our first summer. And we were like, oh, this is real money. Okay. Yeah. We're getting paid to live at the beach. This is great. So one by one, I sold my other properties and we ended up buying small multifamily at the beach with bad long-term tenants. Over time, we converted out the month-to-month tenants and converted those into Airbnb. So we still own 14 Airbnb units. It's a little misleading. It's 3 quadplexes and a duplex. So it's only 4 buildings, but 14 units. So that kind of led me into my second time around of doing things really wrong in real estate. I'm just kind of jumping right into it. I realized the single family thing was not the way to get ahead. The short-term rentals, we hit a level of like replacing my income, really good money. But what we were after was that financial independence. But what we should have been focused on was the financial time and location independence. Because what happened is, even though we were making a lot of money, even when I wasn't working and on call, I still had my phone on me. And I was I was on call. I couldn't leave town for 2 or 3 months out of the year. And that's kind of what we all want. So
yeah,
did that wrong the second time away and then had a meaningful pivot from there.
Yeah. Yeah. I mean, so yeah, the single family rentals that's something just about every human in America has heard about as the first step into real estate investing, is getting their first rental. And what they don't realize is, most of these houses are cash flowing 150, maybe $250 a month if you bought it right. And that's true net after taxes, insurance, and P&I. And then, so what's 200 times 12? $2,400. By the end of the year, if you have one water leak, there's $1,800. And then
Yep.
if you have to do a pest visit or anything, your cash flow for that year is gone. So they're like, okay, well, where's the money? Nobody's going to survive off $2,400. So how many times, like you were saying, how many times you got to multiply that to replace your income? That's dozens and dozens. So the real play there is long-term wealth. And I think that's a reason why a lot of people do hang on to those forever is, 30 years down the road, you do have free and clear properties. And that's some of the tax advantages. But yeah, I've never been a huge fan of the single family rentals for that purpose alone. It's like there is no route to time freedom. It's a time suck, really.
Yeah, big time. And we all start there, right? Like all rookies sound the same. Like I'm making, $5,000 a year off of this property. I'm going to have, 10 of these. That's 50 grand a year and I'm retired. It's like, okay, 23-year-old me. Like that's
Mm,
not what's going to happen.
yeah.
But that's kind of the way that your brain works. But exactly what you said, like that cash flow goes away. Here's the reality. It's very hard to scale a meaningful portfolio of single family homes. That doesn't mean people haven't done it. And it doesn't mean that people don't still do it. Typically, like wholesalers and people that are buying them dirt cheap. But here's the tricky thing, it's not just about the next property, it's about not stopping your ability to buy the two or three or four after that, right? You have to have a pathway to scale because what happens is it's really hard to build a portfolio of 50 to 100 to 150 single family homes, but you could do it. But you could do it in 2010 to 2013. I was buying properties then for 30 grand, brick houses with a roof on them, decent roof in that post 2008 crash
Mm,
for 30 grand. Those same properties now are 150 to 180 grand. It's like it got 3 to 4 times harder for you to scale that same portfolio. So it's not just that it's hard, you also have to be in the right time in the market cycle, and we are not there. So
no.
the reality is you have to think past that, and the logical step past that, first of all, is multifamily, typically like small multifamily, and then people start getting into big multifamily. For me, it was small multifamily, and then an asset class conversion, turning
Mm,
them into a different asset class that changes the formula by which the asset is valued. So I could
yeah.
get a fourplex, and then I could 4x the traditional gross potential rental income by taking those 4 units, turning them into 4 Airbnbs. And then one of those units that might have done $12,000 a year as a
Mm,
1 bedroom unit, it could do $48,000 a year as an Airbnb unit. So
right.
one way or the other, you have to have economies of scale, either in the number of units or the efficiency of the unit.
Right. And you are or were self-managing those properties, which is why you had your phone on you at all times. You're waiting for messages to come in and stuff.
Yeah, that's right. I was self-managing them, and there's so much software and technology available that makes it fairly easy. But ultimately, what happened is I I wanted to be able to disappear for months at a time or more or travel, and I was like, well, all I've really done is painted myself into a corner. I've given myself a job.
Mm,
Now I'm implanting pacemakers, and I'm a property manager.
mm,
I looked around to try to find a management company that could get the same kind of numbers that we were getting, and ultimately, I realized no one will mind my business the way that I mind my business. So we spent 2 years building out a property management company. It's called Going Coastal Property Management. It manages my 14 listings and another 75. I've got some incredible operations partners. Spent a couple years kind of building that company out, and then I stepped away. My partners run it. They run it better than it ever ran when I was in charge of it. So a little bit humbling, but that's the
mm.
reality. I had to kind of take a step back and in order for the company to take a step forward. So I'm completely hands off with that. I have an owners meeting usually once every other month to make some hiring and firing and marketing dollar spend decisions. But that pretty much just operates, right? That's what I had to do to make my properties autonomous and just kind of run. But after all that was said and done and the dust cleared, like, yes, we have the value in this company. We get some small owners distributions, but I'm leaving a lot of money on the table because I'm not the one actively running the day to day of the company. So it's like, okay, so we did single families and it's way slow. We did multifamily. It's serious, but it's really laborious. And the only thing we can't control is how much supply is coming into the market, right? We started doing it before it was cool. Since then, there's been a massive influx of more short-term rentals that dilutes the demand a little bit
Right.
or spreads out the demand over the supply, obviously. So I took a moment and I was like, okay, the question that I have for myself is like, if I know at this point that pretty much any real estate deal you take on, single family home or quadplex conversion or whatever it may be, they all honestly kind of take up the same amount of mental energy and time and space in your life. It's like, all right, well, if I'm going to take a deal on, I should take the biggest deal that I can, but let's stop focusing on things for the financial implications alone, right?
Mm-hmm. Right.
What we really want is not financial freedom. We think we do, but we don't. What we really want is financial, time, and location independence, because those three things together create an independence of purpose. Independence of purpose is where you go where you want, when you want, and do what you want.
Mm-hmm.
So I started the aggressive pursuit of the most passive investment strategies that I could find. And of all the successful older investors that I spoke with, it ultimately came down to around three things in my market. It was hard money lending and note lending. I didn't have the $1 million to get started there. It was mobile home parks. I was already a little bit burned out on tenants because of the short-term rental thing.
Right.
And it was self-storage.
Yep.
I was like, okay, wait a minute, self-storage. So you're telling me you're going to rent someone a box of air. There's no kitchens, there's no bathrooms, and hopefully there's no one living inside the units. I was like, I get it. That makes total sense to me. So with that in mind, I started networking. I've always been a big believer in relationships. I'm a natural extrovert, but who we are now is the same person we're going to be in the future, with the exception of the places we go, the people we meet, the content that we consume. So um, through local networking, I met my partners now. It's a father and son team of Eric and Levi Hemingway. They had a 30 years of commercial construction experience, had been doing self-storage for years. And they had started doing self-storage conversion projects, which means instead of building a self-storage from the ground up, they bought a couple of old, nasty warehouses and converted them into climate controlled storage. So you can
Mm-hmm.
get that shell of a building for pennies on the dollar.
Right.
And I was like, okay, this makes sense. And the strategy jumped off the page to me because I was already doing the conversion strategy with my short-term rentals. And I understood the value of, like, I can buy something for 600 grand with really bad tenants in place. I can get the tenants out. I can renovate the property, turn it into an Airbnb, and it's worth 1.5 now because of the cash flow.
Mm-hmm.
Got it. And then you can refinance, you can pull money out. A couple hundred grand is non-taxable. Like, you got all the commercial levers that you can pull.
Right.
I was like, their strategy jumped off the page. So I was doing medical sales, but at the end of 2020, beginning of 2021, we bought an old Kmart building in Reidsville, North Carolina. We bought the building for 1.5 million. It's 87,000 square feet. The replacement cost, if we just wanted to build that shell, is 6.5 million.
Yeah.
But it had been sitting empty for 10 years. It's disgusting. There's very little appetite for giant big box retail space. But think about an old Kmart. Typically a great corner, good visibility, good traffic count, good residential density in a 1, 3, 5, 7 mile radius. There's a reason why that building was one time a large employer, and a lot of people in that community drove there to get their home goods. And even though they don't do that anymore because Amazon and Walmart put them out of space, it still is a great place for those same people to drive back to the same building and pay us to put the same stuff back inside of it, right?
Yeah.
So a little inverse flow of that micro economy. So we bought the building for 1.5, we put 2.5 into it, and it appraised for 9. And I was like, okay,
Not bad.
this makes sense, right? And so it was my partners and I, and then we raised around 700 grand from a handful of the doctors that I worked with. So they were our partners on that deal.
Mm-hmm.
So that was a joint venture. Then we filed and put together syndication. We did another Kmart deal in Danville, Virginia. And then we did another conversion, then another conversion, then another conversion. We were doing these as 506B syndication deals. My job was to raise capital from groups of investors.
Mm-hmm.
Most of my buddies were physicians that were white coat professionals that all have money but don't have time. Without time, you can't get experience. So we did it 5 or 6 deals, and then I left medical sales in November of 2022 to be full-time as a general partner. Our group is called Nomad Capital because a nomad goes where they want, when they want, does what they want.
Yeah.
And we're currently sitting on 150 million in assets under management. We've got a 2-year path to get to 300, 5-year path to get to 500 million, and 10-year goal of getting to $1 billion.
Man, that is awesome. That's
Thanks,
amazing.
man. It's
Yeah.
been a lot of fun, but it's the same thing, right? Single families, small multifamily, converting it to Airbnbs. It's me finding people that are more talented than I am,
Mm-hmm.
using what I have as a network and bringing it all together. But it's honestly the same thing. It takes a little longer and it's on a bigger scale, but
Yeah.
yeah, it's a lot of fun.
And that's what a good operator does is, they're the cog and the piece that puts everything together.
That's the idea, right? Like for any success, anybody that's listening to this, for you, for me, for anybody that's doing real estate investing, a successful deal always takes three things. It's time, it's experience, and money,
Mhm.
right? And this is a situation where my job is to find people that have capital, but they don't have time and they don't have experience. And it makes sense for those people to partner their capital with myself and my partners, and they have 30 years of commercial construction experience and, a portfolio of, 4 self-storage facilities that they bootstrapped before we got started as a syndication. So the experience is there, the track record is there, and you put those three things together: time, experience, and money. And the idea for syndication is you're pooling capital together to take on projects larger than what any one individual could likely do on their own. And in the long run, the whole is greater than the sum of its parts.
Yeah, yeah. I got a handful of questions. One thing you brought in the beginning is that struck out to me because I've owned storage in the past as well. Is that with single family, or I guess any residential where your tenant is a person or family, those landlord laws, and every state's different, but those landlord laws are typically more stringent, and it's hard to get those people out. But with storage, there's no landlord tenant act or any other laws that make it difficult to relinquish somebody's tenancy on your property. Back in Texas where I own mine, it was a 15-day period. They, non-pay, 3-day and 5-day notice. By day 15, you're able to auction off their stuff and get them out of there. Is that where you're seeing there? And I assume that's one of the bigger pieces that made you move into storage is simplicity and less headaches.
Yeah, it's very streamlined. And also, not every market is like that, but let's take that a step further. Like in COVID, there was a moratorium on evictions for non-payment in
Yeah,
multifamily projects.
scary.
And we saw people stop paying all over the place. Well, there was no moratorium on evictions for non-payment in storage. Storage
Right.
was down 3.8% that first year when everybody was scrambling and figuring everything out. So it's a very stable asset. And keep in mind, like, I was doing Airbnbs besides that at the beach, which has a hurricane risk, but also like that's discretionary spending. People are thinking that's money that they're using for vacation and things like that.
Right.
When times get hard and inflation hits 9%, these are climate controlled self storage facilities. These consumers are putting things in there that they care about. A
Yep.
lot of times, the younger generation is not able to buy houses, they're renting. So they're renting a smaller space and then using a climate controlled storage as an extension of the closet or the garage for winter clothes and wakeboards and mountain bikes and things like that that they're
Right.
actively using.
Yep.
So because of that, it's just a normal automated expense that goes out every month because these are things they care about. Now, whether or not you agree that they should be doing that,
Mhm.
reality is they're probably paying for the item multiple times over throughout the life cycle of renting it. But for one reason or another, these are important items to them and they're not being evicted at a very high rate. And then, yeah, the Southeast is obviously it's pretty friendly in terms of if you own the facility, if somebody stops paying, it's an automated process. They're going to get a series of alerts and then it's going to go to auction. Somebody's going to clean the unit out and you just kind of move on.
Yeah. Yeah, exactly. And then you got the whole tax advantages of cost segregation on a big asset like that. I mean, that's got to be huge, especially when you get an appraisal at 9.5 and you're in, what was the math on that one? 4 million roughly.
Yeah, it's so a typical deal for us looks like we'll buy a building for like 1 to 2.5 million. We'll put 2 to 3 million into it. So it'll be so in the project somewhere 4, maybe 6 million on the high end.
Yeah.
And as a stabilized climate controlled self storage, they typically appraise in the 13 to $17 million range. We've
Wow.
gotten a lot better at picking our markets than when we originally started.
Yeah.
But yeah, we do the cost as soon as we get the CO certificate of occupancy. We're doing the cost segregation study. We take the accelerated depreciation. There's a couple reasons we do that. Number one, like we're typically in the around the 35% depreciation rate. So we're getting a huge chunk of depreciation off the bat that's coming right back.
Mhm.
And then on top of that, our model, because we're buying for a couple million, put a couple million into it, it's going to appraise 13 to 17 million. So at stabilization, we're usually sitting at around 35 to 38, sometimes 40% loan to value,
Mhm.
which means we don't have to sell the asset to give everybody a payday.
Yeah.
We'll do a cash out refinance at like 55 or 60% loan to value, always fixed rate debt, never variable rate debt. At that low loan to value, we can make sure the asset's still going to cash flow, but it gives us millions of dollars to pay out the investors and ourselves. When we pay everyone out by way of a refinance, it's non-taxable because it's
Yeah.
not a capital gain
Right.
and you don't have to pay recapture on that depreciation.
Yeah.
So we take the depreciation to offset the taxable income, which is the preferred return and the cash flow coming out. But the big payout comes by way of refinance, which is non-taxable.
Yep.
And then we hold it. Everybody stays in, the investors stay in, and it just turns
Interesting.
into an infinite return.
Okay. Yeah, because a lot of people doing those refis are doing it for the purpose of getting out the investors. And for one reason or another, either to just get them out and own it free and clear personally through their
Yeah.
asset management company, or to put them into another project. So that's pretty cool for your investors, especially because I mean, why not write it out for the long haul? Everybody involved. That's a win-win-win for everybody.
Yeah, it's pretty unique, right? So like the idea is because and that would be the smart thing for us is like, okay, you guys are made whole, push the investors out.
Yeah.
But the reality is like we're called Nomad Capital. Our goal is to build a tribe of real estate nomads. We're creating enough value that it makes sense for us to let's do a project together and then let's cash everybody out, but let's all stay in and then move on to the next project. And you're going to get a payout there, but you still own your equity in the first one. So if you're
Mhm.
working with us on 3, 4, 5 deals or 3, 4, 5 funds over a multi-year period, those are all passive income streams that continue to pay out, even though you've had those decent short-term returns. And here's where it came from. My partner, Eric Hemingway, he was building homes in Arizona where he's from, built homes for years and years, built his first self-storage facility in 2006. Well, the market crashed. He was leasing it up, but the market crashed in '08.
Yep.
And so when everybody stopped building, nobody was building anything. So Eric and his wife, Rachel, and their 5 kids bought a 36-foot catamaran sailboat in Greece, sight unseen. And we're like, look, we're going to go sailing and wait for the economy to turn around. So it took a lot longer for the economy to turn than everybody thought, right? So they sailed 6 months into their trip, found out they were pregnant with their 6th kid, stopped and had a 6th kid in Jerusalem, kept sailing, sailed for a total of 3.5 years. They sailed across the Mediterranean, eventually sailed across the Atlantic, landed back in Wilmington, total of 3.5 years on the boat. The idea that eventually became Nomad Capital was sparked from that trip, right? They had a self-storage facility that was limping along, making a little bit of money, but they were living cheap. So the idea is you can have a portfolio of commercial assets that are easy to manage, inflation resistant. The management expense usually only gets lower over time, and that can afford you the ability to live a nomadic lifestyle. So when
Mhm.
they came back and got to work, the idea was, okay, building up a base of several facilities to bootstrap Nomad, and then starting Nomad as a way to really hit scale so that our friends, family, and investors together, we can kind of build that portfolio of $500 million to $1 billion worth of commercial assets that allows people to live a nomadic lifestyle, and it's inflation resistant and continues with the living expense increases that we've been seeing over the last few
Yeah,
years.
yeah, yeah. Couple questions. I think I'll start with you went from single family to small multifamily to Airbnb or short-term rental into a commercial asset. For you, although you had the partners to kind of help you that had already been in the commercial space, for
Mhm.
you, what were some of the hurdles that you ran into transitioning into a totally uh, different asset class altogether?
Well, the biggest hurdle is that my job was to raise capital, and I'd never done that before. But I
Yeah,
did have a sales background, so that certainly helped understanding how to put the deal together and structure and explain it to people.
yeah,
There's this mental barrier that we have, this ceiling of like, oh man, it's a big to go from a single family house to a duplex or a quadplex. There's like a little bit of a mental shift there, not
yeah,
much, but for some people, like, oh man, I got to think about this differently.
yeah.
What you don't understand is like, it's really the same thing. And then you're like, my next jump was like, I was looking at like 8 plexes and 12 plexes before I realized, like, what am I going to do? I'm just going to build the same portfolio again that doesn't give me time and location independence.
Mhm.
And that's when I started switching to a commercial asset. And it can be intimidating. What I would say this, making the jump from residential properties, and residential is anything 4 units or under, to commercial properties, which is
Mhm.
over 4 units, even if it's commercial multifamily or whatever. Commercial is so much easier. It is so much easier. The valuations, like what's the value of a single family home? The valuation on that home is the bricks and sticks and what the neighbor paid for theirs, right?
Mhm.
It's comp based. Like what is the area? Are people in that area paying for?
Right.
With commercial, it is strictly based upon what's the net operating income. If you can
Yep.
buy this property, like there, at a 5 cap, if you take a property and you increase the rent $1 a month, in that property at a 5 cap, the valuation on that commercial asset just went up $240. So every time you're walking around and you find a dollar, that valuation on that property just went up $240. So the ability to, I don't want to say manipulate, but the ability to control the fixed value of the asset
Yeah.
is so much easier because it's established by the net operating income.
Right.
So if you can increase the rents or you can decrease the expenses, or in our case, you take a big box that nobody wants and you chop it up into 700 little boxes that a bunch of people want, the net operating income goes through the roof and the valuation explodes. And it's the same piece of dirt, parking lot, and shell that it was 12 months ago when it was an old Kmart that had been sitting empty for 10 years. It's the exact same piece of dirt. You convert it to a different asset class, you put in LED lights and fix the sprinklers and fix the ACs, and you put a bunch of boxes on the inside and it's worth $15 million.
Yeah.
It's so simple. And that's something that I think a lot of people, if you haven't been born in that, it's hard to kind of learn that on your own. But I would encourage people to put the end goal at the forefront of your mind and work backwards from there, because a lot of this stuff is a lot easier than you would think it is.
Yeah. Yeah. I learned that when I was trying to or learning to transition from a lot of my single family stuff I was doing years ago. And I started going to a lot of the apartment seminars, I guess they're called. And I remember hearing a couple of them talk about, well, they wanted to add a laundry facility, like 2 or 4 machines that would make them, $40 a month in quarters. I'm like, why the hell would you want to do that? And then I understood cap rate, and I was like, oh, okay, now I get it. And now that people are talking about adding paid parking spaces, covered parking spaces, little tiny garages, storages on site, and for adding what's that, like $2,000 in machines, and you get a valuation at 5 cap that is exponential. I was like, oh, okay, now I get why people are going into commercial.
It's a multiplier.
Yeah.
Yeah.
When I first bought my storage, it was out in the sticks, chain link fence, push open gate. And I started investigating. I ended up selling before I did anything with it, but I was looking into how to do what you're doing, basically automate it to where I didn't have to take the phone calls or the email inquiries for new applicants and send them the applications. So I was looking into those automations, not only with the door being solar and having it open by itself with the pin pad, but a platform that gave the inquiring customer an application that they were able to fill out and submit and then get approval into the property. I assume, based off of the size and your ability to be nomadic, that you figured that out. Was that a problem in the beginning?
So, luckily I didn't have to figure it out. My partners had already figured it out.
Yeah.
Our syndication is under the name Nomad, and then our construction company, which is in-house, is called Elm Builders. And then we operate under the brand of City Storage. So City Storage has been around doing property management for quite a while, because remember, my partner built up his own facilities ahead of time.
Yeah.
The technology has gotten so advanced. Let me make a guess or two about what you ran up against. Is that you probably figured out the juice wasn't worth the squeeze. And even though you were going to sink some money into it, it was hard to increase the prices and justify that, because a lot of the people didn't care, because the consumer is probably, that type of property. They're usually a little bit, I don't want to say unsophisticated, but like they're just looking for a place to store some stuff that's not that important.
Right.
Right. It's price point. It's always going to come down to price point. So there's a fundamental difference between that property and the properties that we do. And part of the reason is because there's a fundamental difference in the consumer that has changed big time in the last 5 to 8 years. And here's the difference. If you're out, I'm sorry, go ahead. You had a question?
And I was going to say, is that the difference is a non-climate controlled facility versus cheapest in town option, which is what I essentially had.
That's a big part of it. Proximity and residential density is something else. But here's what we've seen. When you and I think of traditional self-storage, we think of one level metal slung buildings, non-climate controlled, chain link fence on a road someplace with people passing by. And if it has good vehicle traffic count, that's cool. It's like a step up from people storing stuff in their barn, right?
Yep.
Well, here's what's changed. The millennial population now makes up 34% of the population. It's the largest population segment that there is. My question was, okay, when I think of storage, I think of baby boomers, Christmas decorations, and heirlooms, right? And they're in there once or twice a year. Is this asset class dying out, and are millennials not using this? Is this something I should invest in, or is it not? What we found is the younger generation are actually using more self-storage than the previous generation did. They're 34% of the population. They're using 38% of storage, but the way they're using it is very, very different. That younger generation is not buying houses, they're renting. And instead of renting a 2-bedroom condo for $1,800 a month, they'll rent a 1-bedroom for $1,300 a month and then store their kayak and their mountain bike and their fishing rods and waders and their winter clothes in a climate controlled storage unit, because that unit for $150 a month is wildly cheaper than paying $400, $500, $600 a month for an extra bedroom in their condo.
Yeah.
Because of the way they're using it, they're in and out of that facility a lot more. So if you are doing self-storage these days, it needs to be, in my opinion, safe, secure, well-lit, easy access, centrally located, climate controlled.
Yeah.
We want to see 10,000 people in a 1-mile radius, 25,000 in a 3-mile, really good visibility traffic count, QR codes on the doors, touchscreen kiosks. These people need to be able to show up at 6 a.m. on a Saturday and scan a QR code or hit their phone, get in, grab their snowboard, their bibs, and get out of town.
Yeah.
32% of consumers in climate controlled storage right now are in and out of the property multiple times a month.
Yeah.
We never used to see that before, right?
Yeah.
So the consumer is changing. Our job is to recognize the behavior and make sure we're putting out the product that fits the consumer demand. And because of that, we can charge appropriately, right? And in climate controlled, because these people have an attachment to the things that are in there, they're willing to pay more. The price per square foot is obviously higher. And then on top of that, the delinquency rate is significantly lower.
Yeah. So I'm just writing down questions so I don't forget it. So in the Airbnb space, sorry, the short-term rental space, you have a software called AirDNA where you can do market research, you find out where comparable are, supply demand, all that jazz. When you're doing your due diligence on a new location, you're looking for traffic, market density or market absorption rates with how many units are in town and how many what the demand is. Is there a software for that to where it makes that easy, or is that another man-hour type position that is doing market research?
Well, bit of both. So we have an acquisition team that's a couple of young guys that are looking at 50 to 70 properties a week to get down to maybe 1 or 2 properties a month that we're going to send a letter of intent on.
Yeah.
But yeah, we use a lot of different tools and we have a proprietary formula that we put together. But ultimately, a lot of the data, especially on storage, is coming from Radius Plus. It's basically the AirDNA of storage. And then we're using things like CoStar and Crexy to do background information, population data, vehicle traffic count. And then we have an in-house feasibility study. And then we have a third-party verification feasibility study that we use with an outside company that's looking at everything from how much storage is in the area, what's the price per square foot, is the population rising or falling, what's the residential density in a 1,357-mile radius, what's the average age, number of people per household, percentage of renters versus owners, because renters are always going to use more storage.
Right.
Make sure not everybody's working for one company in town that could close down and drive everybody out, looking at the permits in line for how much other storage is coming. Like, it's a 60-page report. Wow. So yeah, but Radius Plus is like the go-to AirDNA type data for storage, but it's not just about that. It's about the population being on site, walking the area, driving the area, kind of getting a feel for what's happening in the economy. Yeah. Are there big incentive projects coming? Is there a lot of growth? Can you smell a Chick-fil-A or McDonald's in the parking lot? If so, you're probably in a really good spot.
Yeah, yeah. You mentioned Crexy and CoStar. How are you using those two platforms for the storages? Because those primarily from my usages in the past it was beneficial for multifamily guys that were doing market analysis on rents and of course comparables. But how are you using those two platforms in the storage field?
So keep in mind, we're not buying storage and we're not building storage.
Right.
We're looking for nasty old big box retail buildings, typically that have been empty for years.
Yep.
We look at a decent amount of on-market deals, but we look at a lot of off-market deals too.
Yeah.
And so we're looking for, anything 50 to 120,000 square feet and good residential density, and anything, we can see when people bought it, what they paid for it, anytime there was a refinance or anything else like that. We're buying these buildings for dirt cheap. Like, all in, we're going to buy a building for less than $20 a square foot. And we're going to put $40 to $45 a square into it.
Yeah.
If you and I built a self-storage facility, climate controlled from the ground up right now, it's going to cost us $120 a square foot for the construction, plus the cost of the land. Yeah. And it's going to take us 3 to 4 years by the time we do the permitting, entitlement, engineering, and everything else.
Right. Right.
Across the last 3.5 years, we've done 2 Kmarts, 3 warehouses, 2 textile mills, a grocery store, and an old soda bottling facility. And we have 3 more in the pipeline right now. Across that portfolio of all the ones that we've completed, our average price for the cost of the building, the land, the parking lot, the construction, everything on the day that we're opening up the doors to rent units is just under $65 a square. So our
Jeez.
model is we're going to move into these small secondary and tertiary markets across the Southeast. We're going to snatch up the old Kmart or big textile mill right in the middle of downtown where other people can't even find the 5 to 7 acres to build a facility. And 12 months later, we're going to be open.
Yeah.
On average, 12 months from the day we buy it, we're open as a climate controlled self-storage. Even if someone's trying to build one in the same market, by the time that they are done with construction, we're full.
Yeah.
It's a quick and nimble market. Now, it makes it sound easy, and it's not rocket science, but it's not easy either. These are major construction projects. So the reason it works is we have full top to bottom vertical integration. In the office where I'm sitting right now, I got a team of acquisition guys grinding through 50 to 70 properties a week. We're raising capital in-house. We've got construction in-house, building at cost plus 12%, and we have property management in-house, managing a portfolio of facilities at 5%. That's 3% property management, 2% asset management.
Mhm.
Meaning we're not paying retail costs for the buildings. We don't pay retail costs for the construction. We don't pay retail costs for the management. It's not about getting rich on any one of those components. It's about landing at a low enough loan to value when we're stabilized that we can refinance, pay everybody out tax free, keep it, and then move on to the next one and continue to scale.
Yeah. Another random question. So you were obviously going outside of your market and your construction's in-house. Are you sending your crews out, or is that a subcontracted situation?
We subcontract some of the stuff locally. If sometimes we'll do things like build a mezzanine and put in a lift,
Mhm.
things like that. We have to, or like the sprinkler system, things like
Yeah.
that.
Yeah.
We subcontract, but we also have site supervisors that will move like a trailer, like a fifth wheel to a property, and they go home on the
Yep.
weekends and they'll be on site. In our market, we're based in Wilmington, North Carolina, but we're operating across North and South Carolina, Tennessee, Virginia, and Georgia. So right now we've got projects, 2 projects in North Carolina. One is finishing construction and opening next month. Another one's got about 6 months to go. We're kicking off a project in Florence, South Carolina, and in about 45 days, kicking off a project in Albany, Georgia. So kind of just, we have site supervisors that live in that area.
Yeah.
They're boots on the ground. And then we've got 5 guys here, directors and superintendents running the show from here.
Wow. Man, you've built an incredible team. That's awesome.
Well,
And
my partners have, and I've been
yeah,
lucky to be a part of it.
yeah.
So
Well,
I
I
got the
mean,
easy job, man. These guys are like, their construction, the stuff that they're pulling off is incredible. The vision that they've had. I just get to talk to real estate investors and raise capital. I got the easiest job in the world, man. I like to talk to people anyway. So
yeah, yeah. Well, I mean, it's quite clear that you know exactly what you're doing, and your experience is showing. So,
thank you.
yeah. Well, storage has been an interest of mine for countless years. So I can continue this conversation for hours. But for those looking to reach out to you, what would be the best option for that? Is it email, social?
Sure. Yeah. The easiest way is just go to our website, which is nomadcapital.us. If anybody wants to email me, it's clint@nomadcapital.us. I'm on Facebook and LinkedIn, Clint Harris with Nomad Capital. And I would just say that the same thing that we talked before. The reason the strategy is important is the same way that like the Burr strategy with single family properties is
Mhm.
important. It's if you're investing, whether you're thinking about investing passively with somebody else or doing it yourself, it's not really about the next property for you. It's about the one after that, right? If that next property is not the final step to your goal, and your goal is like, I want to make 200 or $350,000 a year passively, or 80, that whatever the number is, that's what you got to start working and work backwards from there. And what
Yeah.
I see most people doing is if you're using your own credit and your own capital to scale, like small multifamily or single family, you get so hyper focused on the next deal that you don't think about the fact that it's going to take you 2, 3, 4 years because of that cash on cash return to get ready for the next one. And you're making the assumption the next one after that is going to be the same cost as the one now. It ain't. It's going to be
Right.
more expensive. So it's actually going to be another year before you can really get there. And next thing
Mhm.
you know, your whole trajectory is off and you're forced to make changes. So the reason this strategy is important is there's a built-in way to recapitalize and continue to scale. this is the Burr principle. We're just doing it on commercial assets instead of single family. Burr is tough right now, especially in the residential market because of the price and because of the interest rates.
Right.
But the big thing is like, keep everything within perspective of what your final goal is. And if your next project is going to keep you from being able to quickly do the one after that, then what you're really doing is you're stamping out your ability to scale, and that's going to stop you from getting where you want to be.
Yeah. And you think overcoming that was not only switching asset classes, but it sounds like the proper partnerships were pretty important in that process as well. Yeah.
100%, right? My
Yeah.
goal is to put myself where I'm the situation where I'm the dumbest person in the room, right?
Yeah.
And again, it has to have that combination of time, experience, and money. Like for some reason, I've got partners that are terrified to get up in front of a room of people and talk and try to raise capital. I'm terrified of trying to take on a construction project or put together a renovation budget, right? So
Yeah.
it's about putting something together where, you put the egos aside, you care about each other and what you're trying to do and care about each other's families. And you put a skill set together where the whole is greater than the sum of its parts. It's absolutely about relationships, but you're right. That asset class conversion is a huge part of it. Like if we're building facilities up and making them nice, and then we have to sell them for everybody to get a payday, that's cool. And no offense to anybody's strategy, that's what 80% of multifamily operators do, because they're buying it as a multifamily, fixing it up, increasing the rents, and then they got to sell it as a multifamily. And that's fine. But at the end of the day, you're a glorified house flipper. And the day you stop working is the day you stop getting paid.
Yeah.
We're trying to have it so that the day that we stop working, it's because we have a tribe of people that have significant amount of passive income coming in and allows you the time and location independence to do what you want.
Right.
So like it's really, you've got to have massive forced appreciation to be able to recapitalize by way of refinance. The way that we're doing that is that asset class conversion and the forced appreciation of renovating it and turning it into something different.
Right. Yeah. I always thought it was strange, that model you just were telling us about with like you said, most multifamily investors or syndicators have a 5 to 7 year exit plan every single time. And all, like you said, 80% of them, they're selling it. And so they're getting locked up in these 5 year arms and everything, and causing problems in the future, and just kind of pushing that ball down the road. And I've always been a fan of your model, is keeping that asset long term. If it's cash flowing and it's producing and it's not giving you headaches, why get rid of it?
Yeah, if you can get it with fixed rate debt and then, keep it, you break the cycle of trading time for money.
Yeah.
Otherwise, I don't care if you're wholesaling, real estate agent, house flipping, or flipping, $120 million multifamily properties. At the end of the day, you are trading time for money, and the day you stop working is the day you stop getting paid. Breaking that cycle is not as easy as people think.
No.
You have to really be mindful that that's what you want to accomplish in order to find a strategy that kind of unlocks that.
Yeah. Yeah, it's hard to set aside time and energy to switch from your main business to merge into another one, because I'm in the middle of it right now, frankly. I'm doing a lot of flips and land flips, and that's why I asked you about manufactured homes. Is I'm doing a lot of manufactured home placements.
Cool.
And moving into the note business, although you're making me reconsider now, but taking energy away from the main business to, in a sense, build another business. It's not only it takes a lot of energy, but it really messes with your mind, because you think you're going to one, start losing money, and then start ruining your current business while trying to get the other one, and you feel like you're in some sort of limbo.
Well, let's unpack that a little bit, right? So you're dead on with that. That's a big case, because you have to put life energy to get that next venture off the ground. The reality is, like, you're actively flipping and you're doing these deals and flipping land and you're placing mobile homes and things like that. I'll be the first to tell you, you are going to make a better margin there than you will make by investing passively into a syndication, right?
Right.
Well, let's fast forward this 15 years, and let's say you're still doing the same thing. You're still, at some point, like, the day you stop working is the day you stop getting paid. At some point in your investing career, and it's usually in the mid 50s, sometimes maybe a little later. That's the 57 is around the average person that comes to us and is like, I'm tired of this other stuff. I want to do syndication.
Yeah.
At some point in your career, you will get to the point. I'm not pointing this at you, but like, this is the collective we
Yeah,
will
no,
get to a
please.
point We will all get to the point where our time is worth more than anything else, right? Are you going to, there's not a lot of 80-year-old house flippers out there,
No.
right? You get to the point where, and some of us do this because we love it, and I get that, and I'm
Mhm.
one of those, but you will get to the point where your time is worth more than anything else. And if you can go make 35% margins by grinding it and trading your time for money and flipping houses, then go do that. But what you got to remember is there's going to be a day when your time is worth more than anything else. And it makes more sense for you to take some of that capital and invest it with a syndication operator for them to do it full time. Instead of making 35%, you're going to make 19 to 23%.
Mhm.
But you don't have to do anything but read the monthly newsletters and the quarterly financial reports if you want to.
Yeah.
The mistake that people make is they wait until they're burned out of that active investing. Then they start investing into the passive syndication side of things. And what they usually need to do is give themselves a 3 to 5 year runway for that money to start snowballing. It
Right.
takes its growth, right? Like we're developers and ours are development deals. But even for the ones that start cash flowing right away, you really have to give it a little bit of time before that ball of capital grows into a meaningful way where you can split it up and start making multiple passive investments.
Yep.
The mistake that a lot of people make is waiting until they're burned out. And so what I would encourage you to think about is like, picture what's your age and what's your number that you're shooting for in terms of passive income, if that's what you want, and then work backwards from there and be like, okay, can I take at least a little bit of this and diversify and put it in with different asset, different geography, different operators, different time structure, and different debt structure
Mhm.
so that you're building a portfolio that is slowly growing in the background? Because the idea is every time someone, one of your listeners, me, you, anybody, every time we make an investment into a passive investment strategy, we are buying future days off. And eventually, if you buy enough of them, you don't ever have to go back to work.
Yeah.
So the idea is you start doing that sooner, those days off start buying more days off. So whatever you think, yeah, I want to shift to a passive investment strategy later in life, I would encourage you to give yourself a few years and allow that capital to start growing, because you don't want to wait until it starts raining to build Noah's Ark, right? The
Yep.
idea is eventually for all of us, time is the only non-renewable resource. We all will get to the point where our time is worth more than anything else. So go ahead and buy more days off, start investing a little bit sooner in things that aren't requiring you to trade your time for money. The idea is, yeah, you're getting up out of bed and going to work in the mornings, but if you decide that you don't want to do that, you should still have money that's getting up, going out, getting out of bed and going to work for you that day.
Yeah. I'm gonna have to save that quote. You're buying your future time off. That's awesome. I love that one. Yeah, because I
Thank you.
mean, not even just age and health wise, where you start thinking about getting your time back. You know, inevitably the next COVID is going to come, and you're going to be forced to
Yep.
take that time off. So, like, what are your hedges against those problems in the future? It actually reminds me of a book I read a long time ago, and I can't remember the guy's name, but it was "You Need More Money." Now, whether that's cash in the bank or passive income or retirement accounts, wherever that is, but the main summary of the book was when those life circumstances come up, are you ready? And a lot of that is financially oriented in those problems, especially when it comes to time.
Yeah. Like the name of our group is Nomad Capital. And of course, your brain goes to, oh, like, I want to be a nomad. I want to go sail the Mediterranean for 3.5 years.
Hmm.
But like, what if being a nomad, yeah, maybe it means I can go hiking and fishing or do charity or build or do whatever I want to do.
Right.
But what if being a nomad means I have the freedom to take care of a sick friend or family member when they need me, or I can
Exactly.
be present in a meaningful way? What happens if, I have a child that has challenges in their life and I can be present for that? Like, being a nomad doesn't mean that you're off like playing games. It means that you're steering your ship,
Yep.
right? You're in charge, and like we can't change the wind, but we can adjust our sails.
Yeah. Yeah.
And having the ability to have that, you know, the freedom of purpose in your life to change what that looks like. Ultimately, like it's sad to say, but like, you know, ultimately, like for all of us, the luckiest ones out here, somewhere between 80 and 120 years of life, our DNA is going to peter out, right? And 100 years after that, everybody said our name for the last time. So we have a limited amount of time on this earth. Do you really want to spend it trading your best days to pay for somebody else's days off?
Mhm.
Or do you want to try to put yourself in a situation where you're prepared for whatever comes next. And hopefully that means enjoying beautiful places with people that you love and creating
Yeah.
a stack of pictures before you die. But if it means being able to be present for people that really need you, that's a nomad too, right? And money's not going to make you happy, but it can give you freedom of choice and freedom of purpose if you spend it in the right way.
Yeah.
For me, that's the reason, and that's the value of a passive investment strategy.
Yeah. Wow. Well, I'm glad you stopped me from ending the show about 20 minutes ago. I got,
So I'm long-winded, man. I'm
yeah,
sorry.
no, I'm super grateful. I think this last 10, 15 minutes were arguably the best part of the whole podcast. I super appreciate it. And that's me and my wife, we're 38. Our oldest is in college. She started her first year, and my younger is in senior year of high school. And we're thinking about,
Wow.
what's next. And, and that nomadic lifestyle is kind of what we're thinking, because we don't want to be, the world is too beautiful, there's too many people to help to be stuck in one location, and we want that time freedom that we were just talking about. And
Yeah.
and which is why we're going in the notes, and we just bought a software company. But man, this conversation's really made me think more about the commercial asset classes that honestly, I just pushed them aside early last year. So
It's easy to do.
yeah. Well, I do actually have to go this time, so I'll catch you
I
later.
know you
But
do. Sounds
um,
great.
I ask everybody the same question. I think I already know your answer, but I ask everybody the same question every single episode. If you had 6 months to live, what would you do with it?
Wow. Um, oh, man, what a great question. Obviously time is important to me. I have a son that turned 5 years old yesterday.
Mm,
And I've got a son who's going to be turning 2 in a couple months. One of the reasons I've been recording my own podcast is because I want to put some of these things down in a meaningful way that hopefully could have an effect on them later.
yeah,
But time is the most important thing, right?
right.
That the reason I want freedom in my life later on is so that I can spend more time with my family. Because if I leave them with a stack of money, chances are by the third generation, they're garbage people, right?
Right.
But if I can spend a lot of time with them, hopefully more than 6 months, then hopefully I'm a good enough person that it affects their character in a meaningful way that will change the amount of time and character that they input into their family.
Yeah.
Now you're talking about being able to affect generations 4 or 5 years, 4 or 5 generations down the line, long after I'm dust, right?
Right.
So I think with hopefully 50 years ahead of me, time's the most important thing. And I would say with 6 months in front of me, time is even more valuable.
Yeah. Absolutely. Yeah. That
I'm
one.
taking my 5-year-old on a dove hunt this weekend. He just caught his first redfish 2 days ago. Like, that's what I would do for 6 more months.
Yeah. 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 That's awesome. What is he gonna be pulling trigger? I started shooting pretty young. I was dove hunting back in Texas, and one of the coolest things I ever did. Me and my brother and my dad would go out with friends, but the coolest thing that ever happened, my dad got me a single shot 12 gauge single barrel, and that thing kicked so hard. And my favorite stories is to tell people that even the grown-ups couldn't handle that gun, and I was out there blasting away. It was just the funnest thing ever.
I love it. No, pop gun this time, maybe a single shot 410 next year.
It's 410. Yeah, that's what I was thinking. Yeah.
All right,
Awesome, man.
I know
Yeah.
you got to go. Thank you
Yeah.
for having me. I really appreciate your time.
Yeah. Thanks, man. I appreciate it. We'll see you.
Hey guys, hope you enjoyed today's content. I want to thank you all for listening in. And as the great Les Brown stated, if you are not pursuing your dreams, you are literally committing spiritual suicide. We'll catch you on the flip side.